Are you like most sales and other professionals who want to grow their wealth faster than what they are currently doing through their company 401k, even with that company match, the stock market, or just plain saving money? Would you sleep better at night if you had the financial freedom to be job optional in just 3 to 5 years through investing in real assets? Maybe you don't want to stop working, but wouldn't it be cool if you could retire a decade earlier than most? And do the traveling you and your family have planned for years while you're still young and can enjoy it? Let's face it, most busy professionals don't have the time or desire to take on more work outside of their W-2 to grow their wealth. On The Wealth Flow, each week we share the stories, the investments, and take a deep dive into the various asset classes that can deliver that accelerated growth to your portfolio passively. That's right, no extra work for you. Instead, we'll put your money to work. Learn what the 95% aren't talking about and join the top 5% of earners today on The Wealth Flow.
Welcome to The Wealth Flow. My guest today is Brian Daly. Brian has been an entrepreneur for over 25 years in a career that spans IP, communications, wireless telecom, and finance. Brian is the co-founder and CEO of Groundfloor, a wealth tech platform that allows everyone to build wealth through real estate. Brian helps make private capital markets radically more accessible to new participants. Groundfloor became the first company to qualify by the SEC to offer direct real estate debt investments via Regulation A to both non-accredited investors and accredited investors alike. In 2020, Groundfloor made the Inc. 5000 fastest growing private companies in America, ranking in the top 10% of companies nominated. Brian has a JD from Harvard Law School and an MBA from Harvard Business School, as well as a BA from University of Virginia. Brian, welcome to The Wealth Flow.
It's great to be with you. Thanks for having me on.
Yeah, I'm excited to dive into Groundfloor and just hear a lot more about it. But what I'll do is start with really what your background is, how, where you grew up and what eventually led you to real estate investing.
Well, I've been an investor from a very young age, and I'm going to date myself pretty quickly here. But in the mid 80s, when I turned 15 and started earning money during summers, and my dad sent me to the library and said, if I learned what a mutual fund was, and I started putting my money there, saving it and investing it, that he'd match it dollar for dollar. And it was a very smart move, parenting move on his part, which I've tried to copy. I got started then as an investor, and I never really stopped. I kind of moved into index fund investing and then stock investing. And I have over the years really enjoyed being an investor. The move into real estate came because of Groundfloor. I wasn't a real estate investor, wasn't in real estate finance before Groundfloor. And the journey that took us into it is a pretty fun story to tell.
Yeah, well, so let's tell that story. What took you into it?
Well, I was finishing up in the wireless industry, and I had just wrapped up my startup and turned over the reins to the new owners of Republic Wireless, which is the startup that I did before this. I started a wireless company. And while I was really proud of my work there and loved the telecom industry, wireless was awesome and really good to me in my career. I had a non-compete, and I had to, if I was going to start a company, my next company, I knew it needed to be outside of wireless. And so I took some time and started looking in a lot of areas, and I came across the 2012 Jobs Act, an incredibly important piece of legislation for individual investors in particular. I was starting to imagine how individual investors like me, who are interested in stocks and different public market vehicles, could, because of that legislation, what would open up for us to start investing in private markets. And if you're an accredited investor or you have a wealth manager, there's a whole ocean of opportunities for you to invest in that are open to only accredited investors because of the rules, the regulations around securities law that have dated back to 1933, post-Depression era laws. Well, the 2012 Jobs Act changed that in very important ways. I had the good fortune of mentioning this to the managing director of the startup incubator where I was mentoring startups and thinking about my next idea. And he said a light bulb went off for him. He said, I know just the guy you need to meet. He's here in Durham, North Carolina, which is where I was. And said, I know just the guy you need to meet. He actually worked on this legislation. I think the two of you would like each other a lot. And he was right. So Nick Bargava and I met the next day for coffee, started talking about this law and what we thought it would create for individual investors. And we started on the path to build what became Groundfloor. And we hope change the portfolios of everyday people forever by being part of that movement.
Yeah, that's interesting. Because when that law came out, you do know, Brian, most people didn't go through and read it and say, "Hey, how can we use this to open up and launch a new business type thing?" But I don't know if that's your
hazard of having gone to law school.
That's right. That's right. Yeah. Well, it worked out for you, evidently. So that's awesome. Yeah. So tell me a little bit about that, I guess, just from, when you guys decided to launch it, is it in the same format that you currently are with it? And I guess tell us a little bit about what it does for the investor.
Well, it was a lot of work to figure out what kind of product would work, because private market investing is new to most of us. And we were on the bleeding edge of these rules the rules weren't even out. The law was passed, but the SEC hadn't even put forward the rules to follow up on the law. That took another several years. And so we were monitoring that effort, and we decided to start talking to individual investors about if they were to start investing in alternatives, what interested them, what concerned them, what did they already know about it, what did they want to learn about it. And it turns out now, 10 years later, Bank of America has published research that says the younger you are, the more likely you are to view alternative investments, not public market investments, as the way to save and invest for the future. So, the next generation of investors is already thinking in this way. And we decided to move into real estate because it's tangible. Right. It's not like so many of these other alternatives that we've seen take off. And by the way, we've seen a lot of alternatives take off for individual investors. You can access all kinds of things, collections of art, whiskey and wine, trading cards and collectibles. I mean, there's so many alternatives out there now. It's been amazing over the last decade to see it take off. But the alternative investment that we created was, we decided it would be in real estate because it's tangible. We decided to get into residential real estate because that's a part of real estate that we all understand very, very well. I mean, 62% of Americans are homeowners at any given time. So we already are investors in it. We watch house flipping shows. Real estate is kind of part of the American dream in some important ways. And people who think about participating in it are thinking about houses. And that particular corner of real estate has also had some unique benefits for us. We created a short-term debt product that, we provide capital to real estate investors who are going to fix and flip a house or build a new house. The loans that we make are about a year long typically, and they're really high yield. In this interest rate environment, they're 12, 13, 14%, sometimes higher. And those are very attractive yields in any market. But in this market where people are particularly worried about inflation eating away their savings, and people don't know what the stock market's going to do, or they're afraid it's going to be very volatile, our ability to take these loans and chop them up into bits, $1 at a time, that individual investors can buy via our app or on our website. We've built a product that allows people to build portfolios of these loans. And so it's been a long journey to get to that. It's been exciting. We've sold over $1 billion worth of securities to individual investors on our via our website and via our apps. We've returned capital with a very high yield that's typically around 10%, and we've done it on a really short time period. So it's become very popular because of those factors: the category, the short hold time, the high yield, the lack of volatility. It just fills a white space in people's portfolios, and that's what we aimed to do from the very beginning. We've expanded into lots of areas since then, but that's the core product that we started off with and still offer today.
Okay. And so on that, so people can invest, and it doesn't have to be the full, you buying, and forgive me if I missed this, but you're buying existing notes. Is that?
We actually originate the notes ourselves. And this is really important. Okay. There have been a couple of failures of Silicon Valley-backed startups that tried to shortcut the system by buying notes that other people had originated. We didn't do that. It cost us a lot of money to get the regulatory foundation built. It took something like 4 years and a couple $1 million to get the regulatory foundation built to be able to do this. I mean, to build the disclosures and meet all of the requirements to do this. We also realized in the process that to do this on a broad scale, we were going to need to go out and originate the loans ourselves. So we originate them ourselves, and then we manage them ourselves. So once we've made the loan, we're working with that real estate investor who's using the capital to figure out, are they going to be on budget, on time? Is the project in trouble? If so, what are we all going to do about that to return capital to the investors? And we become very adept at running that life cycle. Even if we have to foreclose on a property like a bank, we can do that. Worst case, we can take it back from the borrower, liquidate it, and then sell, provide the proceeds. We don't buy loans for the most part. There are some exceptions where we'll, participate in investments alongside other investors, but for the most part, I'd say 90 to 95% of our volume, we're originating the product.
Okay. And who is your primary end user as far as the loan itself? Is this somebody who's flipping homes, or what are some of the different investors that come to you to originate the loan?
These are professional real estate investors. These are people who they operate a small business that's all about trying to find deal flow. The thing I like about them is people call them house flippers, but that's really an outdated term and concept. There really aren't many houses to flip, where you can just quickly buy it, do some stuff to it, and then turn it around. That low-hanging fruit is long gone in this market. Right. The people who we lend money to are really property developers. They're looking at outdated housing stock, 30, 40, 50 years old or older, and they're imagining what does the modern home buyer want? And typically, our customers are working in that all-important entry-level segment where, there's a lot of supply needed. The demand for entry-level houses in the first and second price quartiles is really, really strong. The supply is really, really tight. And that's it in this high rate environment. It's still tight. Prices are still, high for people. Yeah. I think I recently saw a stat that August was the least affordable housing market in the US in something like over 10 years. So our borrowers solve those problems by modernizing housing stock, developing it into something that people actually want to buy, and then, earning a really high return for it, which is why they can afford to go pay a high yield, a high interest rate on a loan, because they're making so much money in the process of redeveloping it and then putting it out in the market. That's why it's been a great, very, very reliable and high performing investment category of the last 10 years.
Yeah. Okay. That's very interesting. And As far as how long do they typically, are these notes that have a maturity time similar to other commercial products, or what's on average, how long are you holding these notes?
We
Short,
typically write a 1-year note because that's about how long it typically takes to build a new house or renovate, an existing one. Sometimes we'll do an 18-month note if it's a more complex renovation. We saw during COVID, for example, that complex renovations or new builds took a lot longer. So sometimes they'll be as long as 18 months. And sometimes we need to extend the loans, right? Sometimes we all find out, information in the process of redeveloping a property or run into delays that, require extending it. But actually our investors make more money when that happens. So they tend to, after being worried that maybe the project isn't going to make money, they tend to realize, oh, wait, some of these extensions are really good, for my portfolio.
Right.
So they're pretty short term. I mean, I think much shorter term than most other real estate investing categories that I can think of.
Tell me a little bit about how the end user that utilizes these loans is finding out about you and your company. How are they being introduced?
One thing I love about this market, and I didn't know about this market, when I first started, entering it when we started Groundfloor, it's a very tight-knit network. People pay to go to seminars to figure out how to finance their projects, right? They're always sharing notes about this capital source or this investor or this lender, or, they're always trading notes to try to figure out where the best sources of capital. And our product really stands out. People love to talk about it because the way we've structured the product is really unique and very difficult for competing lenders to match. And so when people find out about it, they love talking about it. They love to say, oh, I borrowed money from these guys. And, of course, they're all, the smart ones are very concerned about what it's like to work with the provider of capital, after the loan is approved and the money is, the money starts to flow, because they're reliant on us throughout the whole process, right? To continue issuing draws and make sure that we'll work with them if unexpected delays come up, right? And all of these elements have been important to making us, I think, a really broadly trusted lender. We made 4,500 loans, since inception. We've returned capital on, I think we're up to over 3,000, maybe 3,200 loans now. We've returned capital. So we've gone through this enough times in enough places with enough different types of borrowers and enough situations where we've become pretty good at it.
That's critical when you're needing to, like you said, get the money for the draws, and for it not to be a slow and drawn out process, so that your contractors can get paid. What are some of the measures that you guys put in place to be able to do that on a fairly quick turnaround?
Well, we have operating standards that our asset management team uses. We have cultivated a network of third-party, inspectors who are quick, know what they're doing, accurate. There's documentation that they collect during the process to make sure that everything is what everyone expects it to be. And sometimes we find issues, that are helpful, to the. So we really take a team approach, right? We're not a loan-to-own shop. We're not we don't want to own the property. We do not want to take it back. We just want to make sure that our investors receive the return, which our investors are investing to participate in a note, in a loan. And if they're participating in that, there's a time when the principal is due and there's a rate that they're expecting to receive. As anyone who's lending, if I loaned you some money, and you said, oh, I'll pay it back next week, and I'll pay you $1, for an interest. Well, I expect my principal and my interest to come back next week, which is what we agreed. Well, it's the same thing with our borrowers, on behalf of our investors. And so we take a team approach, but we also are careful to represent the best interests of our investors in the process.
Yeah. Well, I think if you're going to be there long term, you kind of have to do that, right? I mean, it just makes sense that it be a win-win situation. And
at this point, we've been doing this 10 years, so we have a track record and people know what to expect. And we're not a newcomer, for the investor or for the user of the capital.
Yeah. And how about geographically? Where all are you lending? All over the
Well,
U.S. or?
fortunately for our investors, we've concentrated our efforts in the Southeast and the Sun Belt. So
Okay.
the overwhelming majority of our portfolio is in these markets that have fared very, very well, even in
Yeah.
this high interest rate environment. A lot of demographic tailwinds still there in those places. We, relative to some other places where we might have been, some high end California markets or Austin or some other places that have been documented in the press, the prices in our portfolio have been relatively stable, and we expect them to remain that way. So that's been a real blessing, being in sort of the Southeast, in Sun Belt
Yeah.
generally.
Okay. And so is it still primarily just on the residential side, or you mentioned something about possibly branching out? Have you started to lend on other types of projects?
Well, what we realized in this market is that first of all, our customers see a lot of opportunity in this market. So the people who use our capital, they're seeing really good entry points to get in and buy property, right? Aging housing stock is difficult to unload, and there's a great market. There's a great market opportunity for them, and so we're seeing, and they're seeing a lot of deal flow. The trouble is, no one knows what's going to happen with prices over the next sort of year, 2 years, and we pay close attention, market by market, and we form an opinion. Our opinion is not always the same as the entrepreneur who's going to use the capital. Like most entrepreneurs, and I am guilty as charged, I throw myself into this category. We always think the project that we're working on is going to be worth more than maybe reality is going to support. So one way that we have started handling that is we will lend to a certain point of leverage relative to the value as we see it today and in the future. And then we agree with the investor, with the borrower, that if they want to take equity risk, they can do that. And we're also in position to help them raise equity. So we're now using our platform not only to supply the debt, but we have a small sort of sandbox that's growing quickly of opportunities to actually bring equity capital to the table as well. So that might mean, okay, we'll give you 70 or 80% leverage on your project. You'd like to have an equity partner for the other 10 or maybe 15%. Well, we'll go bring that, from our investor base to sit alongside the debt and participate as equity capital. That's awesome for investors on our platform because you can earn higher returns on equity than you do on debt.
Yeah.
Of course, there's more risk, right? So, for a portion of your portfolio, maybe you'd like to take some more risk and earn some higher returns. But it solves an interesting problem in a market like this, where lenders don't really want to take much risk on the future prices. We control our risk by controlling leverage. And that creates an opportunity for equity investors who see opportunity. And so it's kind of fun as a platform to be opening up that part of the capital stack now. And we're busy trying to figure out how to do that at scale. And it kind of feels like when we were building the company in our first product all over again. But we're also doing some new things. Like in that same area, which we call Labs by Groundfloor, we just announced it in September. We're rapidly closing on $20 million of assets under management in just that part of our business. So it's growing really, really fast. We just financed a commercial real estate deal. That's kind of interesting. It's like a mixed use, residential and retail kind of space, which I think is exciting. We've done some financing for land, land purchases. That's an interesting space. And we've done short-term rentals, right? We've done equity in, different types of single-family residential projects. So we're branching out and trying all kinds of new things because this type of capital market brings new types of opportunities and awesome opportunities to make more money for our investors.
Yeah, for sure. So on the equity structure of it, are they holding on until the investor turns around and sells it, and then they make their percentage off of, what the end
Correct.
price was.
Yeah.
Okay. Yeah. I got
And,
it.
and we negotiate these deals, and this is part of why it's important to get the product right early while it's small, because there's a balance, right? There's we have to agree on what the profit split is and how that's going to be broken out. And does it count if we refinance? Well, if we refinance the project, does the equity need to be paid back, or does it go along, right? If you sell the project, well, of course. And what costs get to be deducted from the sales price, and what's the profit split after that, right? When you're doing an equity product, when you're offering an equity product, there's a lot more complexity actually
For sure.
to settle how the investors are going to be paid. I mean, that's one of the great virtues of our debt product, and why we've been able to sell so much of it over the years is, when you're going to get paid, what the rate of interest is. It's usually shorter and more certain, than an equity investment. But we think branching out is pretty important. We've gotten a great response from our investor base on that, and I think watch this space. We're going to be doing a lot more in the coming year.
Yeah, that's neat. So when people are investing, I guess just trying to get an overall view of kind of how it works. So if somebody comes and says, "Hey, I've got $10,000 or I've got 20,000, whatever the number is," and they put it into investing with you, that goes into a larger pool of money that then gets allocated to these specific loans as you originate them. Is that correct? Is that a good way of looking at it? Or
I understand why you described it that way, because the fundamental misapprehension that most individual investors have, and it's because it's all that's existed before, is that the only way to participate in these alternative categories is either to go do it yourself, like go buy a property, and become a private market investor yourself, which has a lot of risk. It requires a lot of capital and has a lot of risk, right? If I go buy into a rental property, for example. Or the false alternative is I either have to do that or I have to invest in a fund, right? And the fund might be a private REIT. It might be a public REIT. They work the same way. There are a lot of issues with REIT investing. People who've been caught up in private fund investments know what I'm talking about during this market disruption or the one in 2008. There are a lot of issues with investing in a fund. The big innovation at Groundfloor is we don't require you to invest in a fund. Instead, we have two experiences to choose from. One is our classic experience. You show up, you get to pick and choose. At any given time, we have about 80 loans, 80 to 90 loans funding. And you can pick, they're graded for their risk, A to G. You can see where they are, and you can allocate your $10,000 however you want. If you want to put it all in one loan, be our guest. We think the best results, the most predictable results, the sort of most reliable results, come when you use the technology to go allocate that $10,000 as you see fit. So you can pick, how much risk do you want to take? What geographies do you want to invest in? Do you like this type of borrower, right? More than like an experienced one instead of a new one, right? And you can sort of, like individual stock picking, you can kind of pick and choose yourself and build your own portfolio. You can use our tools to kind of automate that process if you want. And then we have a new product that's called our auto investor account that you can use. In that case, if you put $10,000 in, it's going to automatically index you into everything that Groundfloor does. So we'll index you into every loan that we have, and then it automatically reinvests you. So as new loans come and you receive repayments, your money is always turning, and you can always choose to pause it, and start withdrawing cash to create passive income. But people are really liking that product. We just launched it last month, and it's a mobile app is the best way to experience it. And it's available on the app stores. People can check it out. It's the cool thing about it is that it does this in $1 increments. So very quickly you realize, like if you go ahead and invest weekly, say for 6, 10, 12 weeks, you quickly have a portfolio of hundreds and hundreds of loans because we launch about 20 or 30 loans a week. And these loans start paying back and paying you principal and interest, and it becomes a cash machine unlike anything I've ever seen as an investor. It's about 10 to 12 times the cash flow that you could earn from a REIT. So if you're a passive income investor, this is where it's at. Like there's nothing like this of having a portfolio that's this broad and this generative in terms of cash flow and yield. And most people, they're not thinking that way because they've been sold this kind of false idea that either you have to put all your eggs in just a couple baskets and be a direct investor, or you have to invest in somebody's fund. I'm here to tell you, you don't have to invest in somebody's fund. You don't have to give up control to a fund manager. You don't have to pay their fees. You can use technology, and technology is here to let you be your own fund manager. And why wouldn't you want to do that? By the way, there's no cost to the investor to use these tools from Groundfloor. It's free.
Really?
It's a no load, no management fee investment, which is what we've all come to expect in the public markets from index investments. So it's very similar to that.
Okay. And that's really neat. That's a little different than what I was expecting. And the ability, I like the idea of, spreading it across and indexing it across what, all of the different investments
We just
that
know
you guys
indexing
do.
wins, right? I mean, this has been settled. In the public markets, it may be boring, depending on your outlook. But, and there was a big fight about that in the 70s and 80s in the investment industry, but the fight's over. Indexing wins. For most people, most of the time. If your name isn't Warren Buffett, you should probably be indexing. And we think that's true in alternatives as well. It's just alternatives are too new to really have indexing available. And we're one of the first options that's gotten large enough. Like I said, over $1 billion of securities sold. We're one of the first that has gotten to scale where you can credibly index, into the category. And we're really excited about that because I think that's where we start to bring in a broader, set of investors who are just trying to save for their future. They want to make sure they don't lose their money. They don't want to be the sucker at the poker table. They don't want to pay half or 2/3 of their gains to some fund manager, which is what happens, by the way, when you look under the covers. And they don't want to be stuck. They don't want their money being stuck in some fund. So we're all about turning that power over to the individual investor. And that's where I, even 10 years in, I get pretty fired up, as you can tell about it.
Yeah, no, that's cool. And then what about as far as you mentioned the app and being able to use that app, but you also had said you can look at kind of how you guys are scoring these potential deals and choose the ones that kind of fit your risk profile the best. Is that all available to you right there on the app, or?
So in the app, the latest version of the app has two different experiences. One is you're just indexed into everything dollar at a time. That's, what we've announced is Groundfloor 3.0. That's our auto investor account. There's another experience that's available only on the web where you pick and choose the loans you want. And by the way, you can also invest in these Groundfloor notes, which is another product that we launched earlier in the year that allows you to take a little less risk, invest in pools of loans, for example, for a defined period of time. So if you're on the web, there's a whole bunch of options. These equity deals are there. If you go over to Groundfloor Labs, kind of that section of the website, you can do a lot. It's a platform. You can play and invest in whatever you want to do. There's a lot of different options. The middle ground on the mobile app is our investor account that allows you to use our investment wizard to sort of quickly on your phone allocate into defined buckets that you get to tune. So you can say, well, I want a more middle of the road allocation, or I want a higher risk allocation, or I want, sort of a very conservative allocation. And then the software will pick out those investments for you and allocate you into those. So it's kind of a middle of the road between the full world of choice that a lot of people find kind of overwhelming. Like, I don't know what to invest in. There are 80 loans. Which ones are good?
Right.
So we've built tools to solve that problem, but the ultimate is this automatic investing tool, the auto investor account that just does this magically, right? And we have this little tool called the diversimeter that will tell you how well you are diversified right now relative to what you could be. And so, you can kind of go open up the app and see like, okay, am I doing well on diversification, or, what do I need to do in order to be a little bit better diversified? What do I do in order to change that? Because we want people to be very highly diversified. We think that's healthy within the platform.
Yeah. What about as far as things, Brian, have changed a little bit over since interest rates basically have gone up, right?
Oh, sure.
Things are a little bit different. I'm sure there's some. What lending restrictions or things have you done as far as the maybe loan to value that you've adjusted since, say, even this time last year? Although
So
this time last year it was kind of starting, but
our investment committee reviews lending guidelines every quarter. So we look at it competitively. We look at it in terms of what we expect to happen in the market. And I can speak in generalities because, we make these changes every quarter. We're fine tuning things all the time. A few major changes that we've made. Number one, we've tightened up on leverage. Successively, we go into the portfolio and we find markets or borrower segments or project types where we're less willing, to extend as much leverage. And then I mentioned, we use equity capital to come fill that in, for the customer, which I think is really constructive. Because hey, if you're going to be taking an equity-like risk, you should probably be paid an equity-like return, in this market. So that's one. We've really reduced leverage. It wasn't uncommon for very experienced borrowers. We used to have a program called Loan 100, which would lend you all of the costs of the project. We don't do that anymore because this market isn't a rising price market, right? This is a, more uncertain price environment. So if you want 100%, you've got to give up some equity upside, right, in the project. So, that's one example of a product that we canceled early on in this tightening cycle. We've also, in addition to reducing leverage, we've also increased rates, which is important for the investor because, hey, if I can get 5% in a money market, or I can go into the treasury market and buy on the run treasury securities for 4 3/4 or 5.5, maybe even sometimes. Am I being fairly compensated for taking the additional risk of these real estate investments? Well, when rates were near zero, 10% returns looked pretty good, right? 9 or 10% returns look pretty good. Now that rates are more like 4 or 5%, we've had to increase our rates to be competitive and make sure that investors are earning a fair return. You want to make sure that the projects still pencil out. So that's the balance, right? We're always looking at that to make sure that the interest costs are not so high that it makes the project unworkable. So again, that's a place where equity capital can help because you just decide to split the profits and solve it that way. And then the third change that we've made is really to bias our programs, our best rates, our best leverage points to the most experienced borrowers. Because we think in a market like this, it's really the jockey, it's really knowing. For sure. I mean, look, as an investor, you go buy a property, you're going to renovate it. You have a lot of choices that you can make about, the costs of the renovations. Which renovations do you prioritize with your limited budget? What price point are you driving to? And the best people at this, they can make changes on the fly based on how they see the market changing, and evolving. And so we reward the best borrowers with more leverage, lower rates than we do sort of less experienced borrowers or people without a track record. And that's been a change in this environment. It's more demanding to make money. It's harder to make money in this market. We demand more. And I mean, people ask me like, well, are you stressed out about this market? I'm like, why would I be stressed out? We have better credits. We have higher rates, of return, and we have less leverage for it. It's a great market to be. It's good to be the bank, man. That's the thing. That we help people get to be the bank, and there's a reason that banks, make so much money. It's a good place to be to have this kind of position in the capital stack and be able to charge for it when you have the capital.
Yeah. Okay. What do you foresee as far as maybe changes in the future? If you were to look, 5 years, 10 years down the road, Brian, what do you see? I'm sure you'll modify and continue to offer different products, but tell us a little bit about kind of what your vision is.
Well, look, when we started the company, we had a hypothesis that the source and structure of capital matters to what gets built, by whom, on what terms. We had a theory about that. Now I have 10 years of evidence where I know that's true. So I have news for fund managers and other intermediaries. I have news for people who have been taking retail investor money with exorbitant fees and locking up their capital. I have news for people who feel like they're part of the country club set and they'll get to decide what gets built and they'll have all the capital to do the building. There are more people coming into this market on the back of these liberalized securities laws, and it is a wondrous thing. There are more investors who are going to get the benefit of this. It's not just going to be the private, equity hedge fund crowd. It's not just going to be the accredited investor segment with wealth managers and, walking around with PPMs to kind of help rich guys be richer. This is about helping everyday, ordinary Americans who deserve the same opportunity for their money that all of these other people have had for a long time. They're coming. The unwashed masses are coming. They're coming at scale. Technology and distribution is changing this market in the same way and for the same reasons that it changed individual stock investing in the 90s and 2000s and 2010s. The meme stock revolution, you can feel about it however you want, but there are new people at the table in investing. And that's going to be true in real estate, and it's going to be true in other alternatives. And brace yourself, because if you're an incumbent, you can dismiss all these people and say, they're small-time investors, or, these platforms are not large. But if you read Clay Christensen, he tells you what happens with disruptive technology to the incumbents. And that's what's happening over the next 5 to 10 years. And I know it. And the Pandora's out of the box. Watch out. And I think it's just a great time to be an individual investor, because today we stand to benefit in the same way that we benefited in the 80s and 90s, a previous generation. The baby boomers were right there, loving it as the stock market soared and people got into individual stock investing. Now for no cost, you can go buy a Fidelity ETF and many, many others for zero cost, no costs. You can trade on Robinhood for no cost, right? And that is coming to alternatives. And I think it's awesome.
That is awesome, and I like the idea that somebody can invest whether they're accredited or not. I think most of the audience knows what an accredited investor is, but Brian, maybe shed some light on that and how being able to offer this product to non-accredited really kind of doesn't make it some exclusive club that you have to be in order to actually get in on the action.
Here's the thing. To be an accredited investor as an individual, you have to make $200,000 in salary a year for each of the past 3 years. These are not Groundfloor's rules. These are the Securities and Exchange Commission's rules. Right. This is the rule set that we live under. Or you have to have $1 million liquid, exclusive of your primary residence. So your house doesn't count. That description fits about 5% of US households on a good day. Might be 6% now with the markets being so high. That's a pretty exclusive club. There are a lot of young people who don't yet make $200,000 a year and don't have $1 million liquid that want an opportunity to grow their wealth too. But here's the best news. This was also something that we theorized about and then we saw happen. It turns out if you do the work to make these products available to everybody, and understand it is a lot of work. It is not easy to deal with the SEC as we've done we've been an issuer for 8 years now, and we've worked with them for about 10. It is not easy work. It's very expensive to pay the accountants and the lawyers. Our offering circular and our financials look like that you would get from a public company. It's one notch below what you would get from a public company. So it's expensive, it's onerous, but you know what else it is? It creates a better product for everyone. So now, if you're an accredited investor, you benefit from this work because now we're cleaning up this wild west of private market offerings, right? We're subjecting these offerings to the same level of disclosure that public offerings have. The rules are very clear about and rigorous about what needs to be disclosed and what counts as a disclosure. There's an examination of those disclosures. Audited financials come out to show exactly what you're investing in so that you know and you have a fighting chance to understand it or to rely on other people who did. So sunlight has come in. So it's not just about expanding access. It's also about improving the quality of the investment. And that's something that, we have a lot of accredited investors on our platform, and they invest with us instead of all of these other options because of that rigor, because of that disclosure. It makes a hyper efficient, more reliable, more investor friendly set of offerings. And that's why we've done it, right? We did it because of this insight about capital markets, and we thought capital markets would work better. And then we stood back and watched while we went through the rigors of the process to see how it actually made the investment product better for the individual investor. So it's great news. You don't have to be an accredited investor in order to invest in this stuff. Check. It's also great news if you're an accredited investor and you're tired of worrying about, or, you're worrying about what you're getting. How's it regulated? There have been some cases where like these so-called crowdfunding platforms have been defrauded, and in return, some of their investors have been defrauded. Well, how did that happen? Well, I would submit it's because they didn't go through the rigorous process of qualifying these investments. They took the shortcut of only selling to the guys with the money. And if you're one of those fortunate people who's an accredited investor, you have to ask yourself, where am I more comfortable? Something that's regulated, like my public markets are, or something that's not regulated that could be, hopefully people aren't committing fraud. And I'm not alleging that people are, but there's always that question in the back of your mind. How much do I trust this portal? How much do I trust this website? How much do I trust this sponsor? How much do I trust my wealth manager? Are they getting paid somewhere in the equation to bring this to me? And so I think there's, we're entering a new day, and it's great for the accredited investor and the non-accredited investor alike.
Yeah, for sure. No, that's really, really cool. Love hearing about it. And my daughter's always interested in trying to find out ways she can invest and where she lives.
Well, she
trying
should,
to buy.
I'd love it if she would download our app on her phone.
For sure.
And, you can put $100 in, and just see how it works. And then watch it, grow and turn. And I think it's exciting. I'm very biased. But if she tries it, let me know.
Yeah, I'll definitely do that, Brian. That's cool. All right. So when you're not investing and working on all these cool projects, what do you like to do outside of work?
My wife and I love hiking. We spend a lot of time in Telluride, Colorado, where we have a second home. And
nice.
our golden doodles, we have too many golden doodles, and they love hiking with us. I think last summer we did 2 trips to bag some more 14,000 foot peaks in Telluride. And that's one of the ways that as a family that we love spending time together. We love to do that.
Yeah, that's a beautiful area for sure. All right. And I've got a couple more questions for you if you have just a minute. And this is a question I ask every guest. But if you were to give somebody some advice that maybe is just starting out, they're just beginning their investment journey, what advice would that be?
Well, look, I was this person at a really early age. And the advice that I got from my dad was know what you're investing in. Know it cold. Read the fine print. It's not that you're forever going to look, reading the fine print and digging in. It can be pretty boring for a lot of people. I actually like it, but most people, I think, tire of it over time. But putting the effort in early to learn the difference at a detail level between whatever you're investing in, whatever you're into. If it's notes, if it's Groundfloor stuff, download the offering circular that Groundfloor has on file with the SEC and read it. You just read it and do yourself that favor, because once you've read a few of them, you'll understand what the differences are between them and how to understand what you're seeing above the surface, right? Of that. So I would encourage people to, especially when you're getting started, if you're interested in investing something, do the work to dig in as deeply as you can and examine all of the disclosures and ask questions if you're permitted, if you have a venue to do that. But learn as much as you can, not about investing in general, that's fine, but learn about the specific investment. Go deep in that. And then I think that can help a beginning investor understand lots more investments from that point forward.
I think that's great advice. How about a book recommendation? Anything you've read recently? It doesn't necessarily have to be real estate related, but just anything you've read recently that you'd share with the audience.
The book that always comes up for me whenever I think about this question is The Courage to be Disliked. It's an interesting book about psychology, about how to think about being an individual. And I think it's particularly good for investors and entrepreneurs, because as investors and entrepreneurs, both sides of the table take a lot of arrows, hopefully not from each other. Right. But if you're out there trying to create something new in the world with your investment dollars, or as the user of investment dollars, I think there are a lot of, the critics can be really loud. And I think this book, I've recommended it to a number of entrepreneurs because I think it gives a very solid grounding in how to think about that problem and how to see opportunity in it and what to do with that, what to do with your fear, what to do with your self-doubt, what to do with your sense that you might be an imposter. And I think it can be eye-opening for a lot of people. So that's a book that The Courage to be Disliked is a worthwhile read that might not already be on everyone's list.
Yeah, hasn't been mentioned yet on the show, so I'll definitely check that one out, Brian. All right. Well, I want to leave the audience really with how people can find out more about you if they want to get involved with Groundfloor. Kind of where do they go to do that?
I love interacting with people on X, formerly Twitter. I'm just Brian_Dalley. That's Brian with an I and A-L-L-Y, D-A-L-L-Y. So that's a great way to interact with me personally. Our website is groundfloor.com. And if you go, you can also find us in the app stores. And I'd love it if people would download the new app. We're still only a month past launch. So, we are soaking in all the customer feedback we can, and we love hearing from people about what they like and what questions they have. And we have staff at Groundfloor who engage with people who are using that new product and can answer lots of questions about it. Awesome. So, and there's also a lot of blog content on our website for people who are interested in what's happening in the real estate market and how does all this stuff work. And, so I'd point people there.
Okay, perfect. Well, Brian, I've really enjoyed this, and I know our audience has found a ton of value in it, and I will have to get my daughter to download your app and get going here.
Awesome.
So
that's
thank
great.
You, Brian.
Thanks a lot, Keith.
Being that you're still here, I trust you found value in this episode. I personally wish I would have known these guests and strategies when I started my wealth creation journey. Go to wealthflow.capital to subscribe to our newsletter. And as a free gift, we will send you our quarterly market report and the top 10 things to look for in an investment opportunity. Take a minute to give our show a rating and review. Help us reach 1 million professionals by subscribing and sharing this episode with someone you know who could also find value in it.